What's up? All right. Good evening, everyone. Hope we are good. Once again, we are here. And in this session, we'll be talking about taxation of business, right? So in the previous session, we spoke about taxation of employment income. And in this session, we are going to also talk about the taxation of business. So this session is going to cover badges, business income, define and badges of trade, then carry forward losses, segmented businesses with various rates. So these are some books you can read to better understand the business income defined. So section 5 provides that person's income from a business is that person's gain or profit from any business carried on for whatever period of time by that person. So any gains you make from any business for a particular period of time is what we term as the business income yield. So in ascertaining a person's income from business, the following should be included: service fees, consideration received from trading inventory or stocks, gains from realization of capital, assets, and liability of the business, consideration received on restrictions of capacity to operate the business, gifts received in respect of business, gains on the realization of depreciable assets, amounts received that is effectively connected with the business, any other amount as a result of the business. So these are self-explanatory. So accessible income from business. So the above exclusions, notwithstanding, the accessible income from business excludes an amount specified in respect of an exemption under the section 7. So section 7 basically talks about exemptions. I pray you take a look at what's at section 7. It talks about exemptions. So an amount specified in respect of final withholding payment, right? We know about withholding payments already, and an amount that is included in calculating the income of the person from an employment, right? Okay, so these are basically the forms of business that is recognized in Ghana. Sole proprietorship, partnership, and then a company. So a sole proprietorship is not liable to pay taxes on profits made from operations, right? So as a sole proprietor, you are not entitled to pay uh taxes on the profit that you've made. Rather, your income is allocated to the sole proprietor and then taxed in accordance with the tax schedules of individuals. So sole proprietors are taxed like the individual tax schedules. So like the individual, sorry. So when you make a profit from a sole proprietorship business, the profit is being added to your normal income. Then you are being taxed like an individual, right? All right. So taxation of partnership. So the following issues should be considered in examining partnership for tax purpose. The salary paid to a partner is a distributed profit. The amount should be added to the respective partner's income and tax. So basically, this also operates like the sole proprietor, right? So the profit here is also what's added to the individual's income and then taxed. So interest on capital is treated as just salary. So they are treated just as the salary. Capital allowance are computed and granted against income of the partnership in the same way as any taxpayer. So that is a company or an individual. So capital allowances is computed and granted the same way like any other thing. So capital allowance is not allocated to partners as in the case of a tax credit, right? Okay. It should be remembered that A member of a partnership is treated as an individual, right? So more or less like the sole proprietorship. So let's look at this. Nana Yakuman is a computer programmer who obtained her bachelor's of science degree from University of Ghana in 2010. Until 31st December 2018, she was employed by SI System Limited. But since then, she has worked independently from the premises Nanaya acquired at a cost of 65,000. Nanaya income for the year ended 31st December 2019 is 80,000. All of this related to work done for SI System Limited. The expenditure for the year ended 31st December are as follows. Basically, business proportion of power is 6,000. Computers was purchased on 1st January 18,000. Motor vehicles were purchased on 1st January 2019. Telephone expenses, fuel and lubricants, bank charges, capital allowance. So when we go back to our allowable and disallowable expenses, right? Remember that expenses of capital nature are not included as an allowable deduction. So basically, computers and motor vehicles won't be part, right? Let's look at it here. All right, so our revenue is here, and we have all the other expenses except the expenses that are of capital nature, right? So basically, you see they are not here, right? So this is it. This is the total expenses or total allowable deductions. Then we take it out of the revenue, then we get the taxable income from business, right? So this taxable income from business is being taxed at uh, the computation of tax liability 2019. So this basically, so from the first 3,456, zero tax is being applied on that. Your next one, your next 1,200, you'll be taxed 5%. Your next 1,680, you'll be taxed 10%. And your next 7,494, you will be taxed at 17.5%. So we can see that basically what we are getting here as the cumulative rate is basically this 1,200 plus this, we are getting this. Then this also plus this, we are getting this. Then this also plus this, we are getting this. So that's basically it. So the taxes are applied on this, right? They are not applied on this, but they are rather applied on this, this, to the amount. Right, so that's it here. So now 5% of 1,200 is 60%, is 60 as you are seeing here. And 10% on this is 168. And then 17.5% on this is 1,311. So in summation, when we add all, we are going to get 1,539. So basically what's happening here is also this plus this is giving us this, right? This plus this is giving us this. That's basically it, right? So this is how the individuals are taxed because a sole proprietorship here. This is more or less like a sole proprietorship. So that's how it is being taxed like an individual, right? So let's go to a company and a trust. So a company is liable to tax separately from its shareholders. Undistributed profits of companies, right? So where the commissioner is satisfied that A company controlled by not more than 5 persons and the associate does not distribute to its shareholders as dividend reasonable part of its income from all sources for a basis period within a reasonable time after the end of the basis period. The commissioner may by notice in writing treats the part of the company's income which the commissioner determines as distributed as dividend paid to each shareholder during the period. So basically what this means is that if a company makes profit and decide not to distribute it, you see, basically when a company makes profit, that profit will be taxed. And then when the company also makes payment of dividend, then those who receive a dividend will also be taxed, right? But if in case a business chooses to, or a company chooses to retain the profit instead of redistributing, right? Still, the commissioner will by notice in writing treat that part of the company's income, right, and then tax it, right? So basically, that's what it means here. So this is an example. This is the same example, Nana year's example, but here he has been employed. Sorry, but since then, she has worked independently from the premises of NYC Limited. So this is the same cost and profit, same cost and revenue. The cost, okay, limited acquired at a cost of 65,000. So the revenue for the year end is 80,000. All of this related to work done for SI System Limited. The expenditure for the year ended 31st December are as follows. The same kind of expenses, and we know computers and motor vehicles are of a capital nature, so they are not allowable for deduction, right? So that's what we are seeing here, the same thing. But here, the profit is being taxed at the normal corporate tax, which is 25%. The corporate tax is normally 25%, whilst the individual tax is different. It's being on like step by step, this will attract this and the like. So this is basically for a company, and the first one is for an individual. So here we are going to talk about how we are going to carry forward business losses. So now let's talk about it. So what is a business loss? So a loss of a person from a business or investment is defined in the section 17(5) of the Income Tax Act 2015 at 896 as the excess of amount deducted in calculating the income of the person from the investment or business over amounts included in calculating that income. So remember, as normal accountants, we know that loss occur when our expenses are more than our income. So basically, that's the same thing here. So when the allowable deductions are more than the computed revenue by the tax man, then they term it as what? As a loss, since the allowable deduction is more than your income, right? So an unrelieved loss is also defined in the same section to mean the amount of a loss that has not been deducted in calculating the income of that person. So more or less like an outstanding loss, right? A business may suffer losses when its revenue from the sale of goods and services and financial income are insufficient to cover its allowable expense and appropriate depreciation of capital. So, period of carrying forward losses. So, way back, right? I think a person operating in the priority sector are allowed to carry previous losses for 5 years, like are able to carry losses for 5 years. That was then for only priority sector, whilst a person in a non-priority sector is being able to carry losses for 3 years. That's way back then. But now everyone can carry the losses up to 5 years. So what this basically means is that when you make a loss this year, right? Next year, when you make, let's say, a loss of, let me do this. Let's say this year you made a loss of 20 million. Let's assume 20 million. And then next year, you make a profit of 10 million. That 10 million will be deducted from this loss. And then still you'll be having an outstanding 10 million loss, which will not be taxed. So basically, this means that you will not be taxed when you make this loss of 20 million. This next 10 million profits, you will not be taxed because it didn't really cover all this. Until, let's say, you make 12 million now, the next year, okay? Now you have what? A profit of 2 million. So now this 2 million is now going to be taxed, right? But if in case you made 5 million profit, then if you have a standing loss of what, 5 million. So this will be carried out, this will be carried forward until 5 years, right? So if at the end of 5 years you are still in a loss, taxman doesn't care anymore. Bro, what I say. So you just have to find ways and means and then correct things. See? All right. So the priority sectors are stated under, so that's it. That was then, but now it has been changed. That's what our lecture told us. It has been changed. Everyone can carry it. So these were the priority sectors: mining and minerals and mining operations, petroleum operations, energy and power business, manufacturing business, farming business, agro-processing business, tourism business, information and communication technology. So tourism business means an operator of a tourism enterprise registered and licensed by the Ghana Tourism Authority. Not you going to sit somewhere and then be like you're doing a tourism member. You have to be registered, right? Vetted and approved by the SDA, not FDO, SE. All right, man. So information communication technology means businesses that are engaged in software development. Energy and power means business of the person who is into power generation. So let's look at this. Congress Mining Company Limited started operating in 2016. In the first year of operating, it declared a loss of 800,000. Name the number of years. So this is a priority sector. Even if now the if not a priority sector, you can carry it for the next 5 years. So meaning that this can be carried into 2017, 2018, 2019, 2020, and 2021. So yes, 2018, 19, 2021, that's what we are seeing here. So that's basically it up to this point. So there's the same thing here, but there is more or less like a non-priority sector, but still it's still supposed to be 5 years. All right, so taxation business of, so now let's talk about segmented business with different tax rates. So basically, what this means here is that when you're operating businesses in different industries, right? So in the tax man's book, businesses in different industries attract different taxes, right? So when you make a loss in one sector, you wouldn't be able to cancel it out through the other one, right? So basically, if you made a loss in a segment that is facing like a 5% tax, and then you made a loss in a segment that is facing 10% tax, you will not be able to cancel them out, right? So that's what it means. So where a person makes a loss and if the loss were a profit, would have attracted a tax at lower or reduced tax rates. The loss may only be deducted in calculating income that is taxed at the same reduced rate. So a lower rate or exempt amount. Where a person's business operation are segmented with different tax rates, losses attributed to a segment with a particular tax rate can be deducted only from income that will be taxed at the same rate. Where the business is segmented, but the incomes are not segmented, there may be the need for apportionment of the income of the business. The basis of apportionment of the income is the contribution of each business line to the total revenue. So that's what I have explained. So let's look at this example. So this example here is this particular business is operating in two systems, non-traditional export as well as local sales. So the export sales is 1 million here, local sales is 500,000. So losses on operation. The traditional export had a loss of 200,000, whilst the local sales had a loss of 80,000. So accessible income declared by the company in 2017 year of assessment as follows. Non-traditional export. So the last year, this was the losses they made. Now the next year, this is the profits they made, 600,000 and then 100,000 respectively, right? So basically, what it means is that since this loss is there, we have to take this loss out of this. Then it will be left with 400,000. Then that 400,000 will be what? Taxable. Here, we have 80,000 loss, and now we've made a profit of 100,000. So we take it out, then it will be left with 20,000. And that 20,000 is what? The taxable income or the chargeable income. All right. So now this was the loss outstanding 200,000, 80,000. Now we've made a profit of 600,000 and 100,000. So we bring it down and then take it out. We take it out, it's left with 400,000. Take it out, it's left with 20,000 here, right? So now we apply our taxes. Here is being taxed at 8%. Here is being taxed at 25%. So you see now we get this as our taxes, right? So an unrelieved loss from business may be deducted in calculating income from investment. However, an unrelieved loss from investment shall be deducted only in calculating income from investment. Thus, an unrelieved loss from an investment cannot be deducted in calculating income of a business. So with this, lecture made an example of, I think, one of the firms in Ghana where they made a loss on business, right? But they made a profit on their investment. What happened was that GRA wanted to tax them only on the investment they've made. Like, you see, the profit that they've made on the investment. And then they tell them that, no, you can't tax us only on the profit that we've made on the investment, but we've also made losses in the business. So we have to do something and then make sure that our losses are being reduced. Because when we add the profits we've made from our investment in the business, we are still in a total loss. So why do you want to tax the investment? According to our lecture, this thing went even to court for more than 10 years. And then the court ruling came out that, yes, what the firm was saying is true. GRA is not supposed to tax only the investment. So basically what it means is that if in the investment you made if the business you made a loss of, let's say, 20 million, negative 20 million, right? And then you made a profit on the investment of, let's say, 5 million. GRA is not supposed to tax this profit, but rather you can use this profit to settle this part of this 20 million, then now you'll now be left with negative 15 million. That's what it means here. But in the case of the other way around, where we made a profit of, let's say, 20 million in business, right? And then you make a loss of 5 million in investment. Still, GRA is going to tax you on this 20 million. GRA is going to tax you on this 20 million. But your loss on this 5 million will be carried forward like that. So you can use your investment to offset part of your losses in business, but you can't use your business to offset part of your losses in investment. I don't know if you get me. You can use investment to offset business profits or sorry, business losses, but you can't use business losses, a business profit to offset investment losses as a business. That's what it means, right? So that's what all this is talking about here. All right. So let's move on. You will see some examples very soon. So this is an example here. From the declaration, profits or loss as provided from in the table below for Endurance Company Limited. Determine how the unrelieved losses will be treated. I remember I told you that business losses can be offset by investments profits, but investment losses cannot be offset by business profits. You have to keep that in mind. So basically, what we are seeing here is that the business is having an income here of 100,000, and the investment is having a loss here of 50,000. GRA wouldn't care about this loss, but will tax the business like that of this 100,000. Right here, the business, so basically what it means is that this 50,000 is going to be used to carry forward for the next year, if in case the investment to make a profit. So fast forward here, the next year, 2018, the business has made a loss of 40,000, right? But has made an investment profit of 120,000. So part of this 40,000 will be offsetted here. So this will reduce the tax value. So now 40,000 will be subtracted from the 120,000, right? Which will be left with 80,000. Remember, in the previous year, they made a loss on investment. So that loss will be carried forward and then it will be offsetted. So 80,000 now minus 50,000, it will be left with 30,000. So 30,000 left is the amount that will be taxed here. So let's look at the answers and see whether it's correct here. All right. So 100,000 was the business profit. That's it. That's what they tax, right? They didn't bring in the investment loss, no. So the investment loss was carried on to the next year. So when they made an investment profit of 150,000, the previous year's investment loss was brought here, and then the business loss for that particular year was brought here. So they will now subtract both of them from the 100,000, then we will be left with 30,000. So the taxable income will be the 30,000. Yeah. All right. So deduction of loss exempt income. So losses from activities that are exempt from tax or from incomes that are taxed at reduced rates cannot be deducted from profits of other business. So that's what I spoke about, that when the tax rates are different, right, you can't really apply those particular, like you offsetting the taxes. So let's look at this example. Maastricht Company Limited declared a total loss of 43,000 in the year 2016, year of assessment. The loss was made up of transport operations of 250,000 from transport operation, and then the hotel operation of 180,000. So the company declared a profit in 2017. 2016, they made a loss. 2017, they made a profit of transport operation 100,000, and then hotel operation 75,000. Look at it here. Since hotel and then transport operation will have different tax rates, even though this profits could have covered all of them, their losses, right? Still, they can't offset it. So this will make this big profit rather bigger. So basically, what it means here is that here this 100,000 will offset part of this, leaving 150,000 as a loss still behind, right? That 150,000 loss will still be there. Will still be there, right? And then now this 75,000 minus this 180,000, since it's a loss. So now you'll be left with 570,000 here. So that 570,000 is the taxable income here, right? And then this loss of 150 will be carried on to the next year, right? All right. So this is it here, right? This is the first loss they made. Yeah. So this was the loss they made in the previous year, and this year's profit, 100,000, right? So it will be taken out, then to be left with 150,000 as a loss. So loss of tax cannot be applied on the loss, right? So that's it here, nil. Then now this is the profit made this year on the hotel operation. This is the loss for last year. They subtract it, they come and get the 570,000. Then they will apply the interest and the tax rate 22% on it. Then they get their tax. But under normal terms, if the tax rate were to be the same, this 150,000 would have been offsetted here. Right, then it will be left with around 420,000 for the tax to be applied on. But since they have different rates, then it cannot happen that way. That's why. So this is the commentary here. Right, this is basically what I just explained. So this is this here. Um, Paragraph 31 of the first schedule of the Act states that the chargeable income of a company other than a company principally engaged in hotel industry would be taxed at 25%. And paragraph 3 of the first schedule of the Act states that the chargeable income of a company principally engaged in hotel industry would be taxed at 22%. Right? So you see, um, here is here states that the chargeable income of a company other than a company principally engaged in hotel industry. So other than that one is 25%. And that principally engaged in hotel industry is of 22%. Keep that in mind. So it is worthy of note that companies which were required to carry forward losses under the repealed Internal Revenue Act 2000 will continue with the dispensation up to the end of the basis period in which the dispensation would have ended under the provision of Act. This is because laws cannot be passed with retrospective effect. So when they pass a law this year, it wouldn't really affect previous staffs or previous transactions. That's what it means here. So this course or halts or stops our meeting today. I hope you enjoyed it. If you enjoyed this session, kindly like this video and also subscribe to my channel. I will see you from tomorrow. I think from tomorrow I'll be recording the tutorial sessions. Yeah, I've solved them all. So we'll be recording. I'll record them on how I went about them, and then we can pick it up from there. Thank you very much. Have a good night. Bye.